Well, good morning, everyone. Glad you could be here. My name is Dave Grant. I will be your presenter today. And if you have not been aware of Finance for Teachers before, we do a lot of webinars throughout the year. Today, as you're aware, we're going to talk about back-to-school savings and how to increase the amount of money that you're able to take home. If you're not aware of Finance for Teachers, or if this is your first time joining us, then let me give you a little bit of background. Now, Finance for Teachers is a financial planning company that works just with teachers. We don't really work with anybody else nor claim to be specialists in anything else other than teachers. Now, the reason being is that myself, Dave Grant, I am the founder, and I'm also married to a teacher. So I have found that as I've gone through my own personal financial planning that there's a lot of questions that teachers have. My wife had and myself had, and we realized there's no one really out there who is specializing in teachers and is not trying to sell products. So that's what Finance for Teachers is. We don't sell any products. We purely work with people based on an hourly rate, or if people want to retain us for the year. And that enables us to go and find the best products for teachers, the best solutions, and to come up with a very customized financial plan for our clients. So that's Finance for Teachers in a nutshell. What about myself? Just to make sure I'm not just some random guy off the streets. My name is Dave Grant. I am originally from England, and I married a teacher 8 years ago, and we're happily married, got 2 children, and live in Cary, Illinois, which is a suburb of Chicago. So I am a certified financial planner, have been doing this for the last 7 years, and have really been focusing on working with teachers for the last 3. And that's something I've dedicated all my research to, finding out all the things that teachers need to know to make their finances the best they can be. So a couple of housekeeping things first. Everyone is muted on this call, and the only way to interact is through the chat box, which is on the sidebar. If you have any questions today, feel free to just throw your questions in. We will get to them at the end, and make sure you're writing them as we go through, just so they keep fresh in your mind. If you're having any problems with audio or visual, let me know through the chat as well, and I'll see if I can adjust things on my end. And you should have got an agenda. When you registered for this webinar, you were sent an agenda as part of the process, and it gave you, 6 to 7 slides of things we're going to cover, and I'll be referring to that agenda as we go through our call today. So let's jump in. So we're going to talk today about the 5 ways to tweak your paycheck and have more money. Now, for most of these things, you don't actually need to get a raise. It's not about earning more to save more. This is about being smarter with your paycheck so that you can actually have more money. So how are we going to do that? The first one, it is actually about, it's a little bit about working your raise to be more beneficial to you. But what you do with that raise gives you something more substantial in the long term. So when it comes to retirement contributions and saving for the long term, most people need to be saving more. This isn't a surprise to America as a whole that we need to be saving more, but for teachers, this is something that I come across frequently, is that people do need to be saving more in order to have the lifestyle that they want in retirement. Now, if you are aggressively saving, this may not apply to you, but I think for the most people on the call, this is going to be something that you need to do. So how do you go about doing that? Well, here's one thing. When you go back to school, some of you are going to be on a contract that you get increases in steps with your salary. So you may be on a contract that gives you a 2 to 3% raise every year to keep in line with inflation and just as part of your contract. Others have taken classes throughout the year, and you're going to find that you've either bumped lanes, and that you'll find that you are getting a bigger salary. My challenge to you is, at a minimum, when you're saving this year, save your raise. So how do you know what that's going to look like? Let's take a look at a paycheck. This is going to be a standard paycheck. You may see more withholdings and more deductions on there. But there's one part in particular you need to look at. That's the total earnings that you earned during that pay period. So for this paycheck, it's that $2,742. you're going to take the paycheck that you get in September and October, and you're going to compare that to the paychecks you're getting in April and May of last year. You're going to see what the difference is. So let's say it's last year you're getting paid $2,542. You've now got that increase of $200. My challenge to you is to save that $200 and don't recognize that you even got a pay increase. So when you go back to school, realize how much has my salary gone up from last year. And that difference is going to be saved to a retirement account. You didn't get any wealthier, you didn't get any poorer, but over the long term, you're going to definitely feel an impact from this. So where do you save this? A lot of teachers are using 403Bs. Some of them are good, some of them are not. And for the most part, during the research that I do, 403Bs are not the best vehicle for teachers to be using. There are different accounts that you can use to save for retirement, and depending on where you save your money, it can have a bigger impact when you get to retirement, depending on where you save, even if you save the same amount of money. Let's take a look. There are accounts that are called Roth accounts. Now you can have a Roth 403B, or you can have an account called a Roth IRA. Now there's a difference between those accounts versus a traditional 403B and a traditional IRA in the way that you save money. So if you're saving to a regular 403B, the money that you're putting in, let's say it's that $200 a month, you are not paying taxes on that $200 before it goes into that 403B. It's then growing all the way throughout your career, and when you take it out in retirement, you'll then pay taxes on everything that you take out of that account. Roth accounts work in the opposite way. Before you put that money in, so before that $200 goes into that account, you pay taxes on it. So let's say that $200 now becomes $175. You put that money in. It then grows all the way throughout your career. When you start taking that money out in retirement, you don't pay any more taxes. So there's no more taxes on that $175. There's no more taxes on everything that it's grown to be. Everything is tax-free. In my opinion, I think you should be approaching saving in this order. One, look at a Roth IRA. This is not tied to your job. They're not available through your district. You actually go to a bank, or you go to a place like Charles Schwab or Fidelity, and you open up an account there. And they will take the contributions out of your checking account. It's a lot cheaper to do it this way. There's no fees tied to using an account through your district. And you're actually going to get a lot more investment options and a lot more cheaper investment options too. So that's why you get a bigger bang for your buck by using the Roth IRA. If you wanted to use a 403B, so it's actually tied to your district and you have a rep and they do a lot of the work for you, try and use a Roth 403B first. And it's the better of the 403B options. If that's not available to you, and for some reason you can't use the Roth IRA or you just don't want to, then you can go for a 403B or just save in your checking account if that is something you don't want to do. All right, here we get a little nerdy. I know a lot of people sometimes come to me and say, well, it's great that you give me that opinion of using a Roth account, but I want to see some numbers behind that. Back up your opinion here. So I will do that. Let's look at using a Roth account versus a traditional account. You'll see in the title of this calculator, it's a Roth 401k versus a traditional 401k. You can change these titles to be Roth 403b versus a traditional 403b, Roth IRA versus a traditional IRA. It's the same thing. So let's say that you are currently 30 years old. You are going to be retiring at age 60, and you're going to save $4,800 a year into this account. So $4,800 a year, you're doing $400 a month. So it's going to be the $200 a paycheck we were doing in the initial example. And we're going to look at the difference between doing it in a Roth account versus the traditional. Now, if you look right at the top, we're going to expect a rate of return of 8%. That's pretty standard. And we're going to say that your tax bracket is not going to change now all the way through into retirement. Now, given that you'll be receiving a pension in retirement, that could be very likely. So look at the impact. You are saving to a Roth account. You're saving that $200 a paycheck. And over that 30 years, right at the end, you're going to get that $567,000. If you were to do that in a traditional account, you would only have $425,000. That's a really big difference. Now we're talking $140,000 there, just because you chose to use a different account. So let that bit sink in. Just by choosing a different account, there's a $140,000 difference in your balance when you hit retirement. Now I do get some geeky and nerdy responses to that, and there's a flaw in this calculator, and I'll show you why. Some people say, well, okay, but if I save to a traditional account, that means I'm paying less taxes. And that's true. So they say, well, what if I took the money I saved by paying less taxes, and I save that portion as well? So as you can see below where it says total contributions, I've checked the box to say, okay, let's invest any tax savings that you had by using that traditional account and avoid paying taxes. I warned you, it's getting nerdy. So how does this impact things? And it does impact things. But you'll see by the chart, if we keep everything the same, you are still further ahead by using a Roth account. Now it's not by much. You're looking at 40-ish thousand, but you're still ahead. If someone said use this account and I'll give you $40,000 at retirement, I'm all over that. I'm taking it. So to summarize that nerdiness, most teachers should be using a Roth account. You should not be using a traditional 403b that the majority of teachers I see are using. You're going to end up with more money in retirement, potentially, if you use a Roth account, if you keep everything else the same. And you may see that if you're doing that over a 30-year career, that could be as much as $140,000. All right, so let's move to a different topic. What about the health insurance you're using? If you looked at slide 2 in your agenda, kind of listed out the different types of health insurance. Before you choose what type of health insurance to use, I want you to sit back and think over the past 5 years, how have you used your health insurance? One, have you even used it? But then if you have, how did you use it? Was it for doctor's visits? Was it for an emergency? Was it for specialized treatment for something for you or your family? Kind of review what you've used it for and see what you might use it for in the future. So everyone's familiar with health insurance. You've got your PPO, you've got your HMO, but you've also got health savings accounts. So a brief overview, and I don't think I need to do this very much in detail, but a PPO is your comprehensive coverage. You can go to whoever you want to, you don't have to be referred to them, and you can choose who you want to work with for your medical, dental, vision treatment there. You're going to pay higher premiums for that. And that's the luxury of being able to choose whoever you want to. An HMO, you're going to pay lower premiums, but you're going to have more restricted coverage. Everybody that you use has to be in the network. Your primary care physician needs to be in the HMO network. And if you want to go see a specialist, so a dermatologist and the like, you're going to have to be referred to them. An HSA is a savings account where you actually save a portion of money every month, and you use that to pay your premiums and you use that to pay for your co-pays and deductibles when you do have to get some health care. Now, picking the correct coverage for you and your family, again, could save you thousands of dollars. Every year, you're going to have an open enrollment season. Some districts have it in the fall when you go back. Others have it in the spring. It depends on what system they want to use. But at this point, you can choose to change your health care coverage. So what do you have to look at when you're deciding this? The first thing we'll touch on it again, how did you use your health insurance, if at all? And this is going to be the most important part. It doesn't matter if you save money. if you're not going to use your health insurance in the right way. If you need specialized care, you don't want to be having to get referred all the time or to someone who's not very good. Look at the coverage available. Some districts may be a little bit more restrictive than others, depending on who they use. But look at the premiums you're going to pay and also the co-pays and the deductibles. You may find that if you're paying a lower premium, you may end up paying more out of pocket for your care throughout the year. And you could have saved on that if you'd have paid a higher premium. So let's look at some stories. So Susan, who is 35, is using a PPO. Pretty standard that you'll see if people have a family. It's costing her $600 a month. Now, when she sits back and looks at her family's health history and what they've used insurance for in the past, no one's had an emergency in the last 5 years. There's really been nothing other than regular doctor's visits for checkups. She doesn't have any special needs. There's no health requirements in her family that required any specialized care. She then compares coverage. She looks at the PPO versus the HMO, and all the doctors that she uses are in both. However, she's open to using other professionals if her main doctor doesn't decide to do an HMO, if he doesn't want to be in that plan. So just by looking at these brief facts, it's going to make sense for Susan to switch to an HMO and drastically reduce her premium. Now, the main thing here is by being open to using different healthcare professionals, you can switch to an HMO and drastically change your premiums. If you're not open to using new healthcare professionals, or they're not in your network you're comparing to, then maybe you don't want to make a switch. What about something different? Jessica's 28, married, looking to start a family, and is now trying to understand, okay, which health insurance option is best for me? There is a history of difficult births in her family. Her sister has had children that have been in the NICU, and that's a hereditary thing. She's realizing that I may have significant hospital stay and medical expenses coming up in the future when I have children. So again, she goes and reviews coverage. She's checked, and her primary physician and her OBGYN are in the HMO and in the PPO. She does want to keep the same and is not really willing to change at this point. So in her family, husband's healthy, hasn't been to the doctor in years. But she's looking at, okay, what happens when I have my baby? She could potentially save thousands of dollars when she goes to have her baby. Doctor's visits, the birth of the baby, the hospital stays afterwards. If it's in an HMO, you're just paying that simple copay. Everything else is covered, providing it's approved. So she's going to save hundreds per month in premiums and thousands in the process of having her child just by choosing a different healthcare plan. So in these cases, if you are dropping from a PPO that is $600 a month to an HMO that's $200, over a 30-year career, you could be saving just under $145,000. All right, so I'll leave that health insurance with you. That's something to look for open enrollment. But now let's look at some other savings accounts that are going to be available to your district. And they're typically named after acronyms. You've got, an FSA and a DCSA. I'm sure a lot of people are going, what's an FSA? What's a DCSA? Haven't heard of these, or I'm just not familiar with them. So an FSA. An FSA is a flexible spending account. Now, you can use a flexible spending account to pay for your medical copays, your deductibles, your prescriptions, any vision coverage that you have, and dental coverage, and you can pay for all of those things with money that hasn't been taxed. So how does that work? Well, let's say that you're going to save $200 for the FSA. And you then go to the doctor, and all your treatment, it was $200. So you've saved the $200, you had to pay the $200 out of pocket to the doctor. You then submit a request to the FSA, and they're going to cut you a check for $200. Now, just by looking at that, it looks like a wash. It doesn't look like anything significant happened or there was any savings. So why is it a big deal? It's all about taxes. The $200 that went into the FSA avoided taxes. So it's just like saving to a 403B. The money that you put in is avoiding any taxation. It can avoid being taxed for Medicare and even for TRS. So if you're in a 15% tax bracket, on that $200, you just avoided paying $30 in taxes. Now you can put $2,500 in an FSA a year. You do that monthly. And if you use all of it, you can save $375 in taxes a year. And this is for stuff you would have been doing anyway. Now again, if you look at that over 30 years, you're looking at savings of just over $11,000. And all you did was save into an account and then ask for a reimbursement. You really didn't do anything that special. So what about the other account? What's the DCSA? That's a dependent care spending account. And this is used for daycare expenses. Now, I got 2 kids in daycare. I've got a 4-year-old and a 2-year-old, and daycare is our biggest bill every month. So if we could get savings any way we can on those daycare bills, bring it on. I'm ready for it. And that's what this account is for. It's the same as an FSA in the terms of tax savings. You can actually fund it with double the amount that an FSA allows. You can fund it with $5,000 a year, and trust me, that's going to get used up in a matter of months. And if you put in $5,000 a year, if you're in a 15% tax bracket when you pay your taxes, you've just saved $750 a year. And all you did was put money into an account, pay for daycare out of your pocket, and then ask for reimbursement. Nothing magical or complicated happened here. Now, if you've got 2 kids and you have one kid go through daycare and they're off to school, you have another kid and they go through 4 years of daycare before school, you've now saved $6,000, not for doing anything special, just by using an account that's available to you. If you're in a tax bracket that's higher than 15%, your tax savings, they go up. So when it comes down to going back to school and open enrollment, find out when you can make an election to those accounts. Understand when can I start making contributions, how much should I put in, because with both of those accounts, if you don't use some of that money, you do lose it. And then start contributing and saving some money. So let's look at number 4. How big is your tax refund and how do you use it? I mean, this is a pretty interesting topic when it comes to tax refunds because everybody has different opinions here. Everyone's saying, I like my tax refund. I do some fun stuff with it, or I have a purpose for it every time that it comes around. I'm going to challenge you on that. That's probably not the best use of your tax refund. And even if you save all of it, it's not the best way to do it. So a $1,200 refund, should you get that at the end of the year, that's $100 a month that you could be saving elsewhere. So you can actually get that $1,200 split over 12 months throughout the year by getting more in your paycheck. And you end up with minimal refund, but you've got $100 more a month that you're going to be using. Now, a $1,200 refund is actually small. The typical refund in the U.S. is close to $3,000. Now, if you were to save $3,000 a year, and if you were disciplined at doing that, that's going to be great. But what's going to be more powerful is actually splitting that up over 12 months and saving the $250 a month. It seems like splitting hairs, but when you break it down to the numbers, it does actually make a difference, and I'll touch on that in a second. So how do you go about getting that? It's all about your deductions and exemptions on your paycheck. So when you go back to school, there's going to be a phone call you're going to make, and you're going to call HR and you say, I need to withhold $100 less per month. I need to get that back on my paycheck so I don't get a big tax refund at the end of the year. The process isn't as simple as that. They're going to have to work with you and understand, okay, when you have your exemptions on your paycheck, if we adjust some numbers, what dollar amount does that give you back? So you'll have to tweak your paychecks to make sure that you actually get $100. But once you hit that sweet spot and you're getting that money back, you don't have to make the changes again. Then when you get that extra $100, it's going to be considered in your mind like a raise, and that raise is going to be automatically saved. So why does it even matter? I'm sure some people are squawking saying, well, just let me not bother with my paycheck and I'll just get the money at the end of the year and I'll save it. Well, let's look at a calculator. What if you said, okay, I'll save $3,000 every year and I'll do that over my 30-year career, and 8% return, we'll use the same number as we have in all our other calculators. And what does that look like all the way at the end? You're looking at just under $360,000 if you did that. That's a great number. What if you took the $3,000 and split it up over every month of the year and had $250 a month? Keeping everything the same, you've now saved $367,000 a month in total, right, when you hit retirement. So just by that small change, you saved an extra $8,000 over the span of your career. Now, over 30 years, that's not a big deal. It's $8,000. But just by changing one simple thing on your paycheck, you've just got given $8,000. Again, it's almost a no-brainer. So our final thing is save your receipts. Now, some of you are aware, and if not, you all need to be aware, when you file your taxes, teachers get a little wink and a nod from the IRS and said, you do a good job in our community. We're going to give you something back. You get a $250 credit every year on your taxes for expenses that you've paid, for things that you've bought for the classroom or to better your career and help the kids learn. So as long as you've spent that $250, you then get it back as a credit on your taxes, and it's a nice gesture. But you can get reimbursed over that $250 credit if you spend things to do your job, or if you do things related to your job that you don't get reimbursed for. So for example, if you use your vehicle, your personal vehicle, to go to school-related activities. So let's say you're a coach and you're driving to different meets and you're driving to practice that's not at your school. So it cannot be commuting. But if you're driving different places and you're racking up mileage, you're spending money on gas, make a note of the mileage. Make a note of the money you're spending on gas and save those receipts. The same goes for going to conferences. If you have to pay for those and you don't get reimbursed, save them the receipts, because you can get some of that money back when you file your taxes. The same for equipment in your classroom. Same for membership dues to organizations you belong to, subscriptions to magazines. All of these things that help you get better at your job that you don't get reimbursed for, save the receipts and you get some of that money back when you file your taxes, and it becomes a deduction on your taxes. So just to recap, the savings that we've gone through in this webinar, if you use a Roth IRA or a Roth account versus a traditional account, you're going to save $140,000 over your career. If you look at different health insurance and you decide that it is a better option to go for an HMO, you could save just under $145,000 over your career. An FSA, you're looking at just over $11,000. Dependent care savings account, $6,000 if you've got 2 kids. That could go to even more. depending on your tax bracket and if you have even more kids. And then saving monthly on your tax return versus saving every year, you're saving just under $8,000 over your career. So just by doing these little tweaks, you could be saving over $300,000 over your career, and you've not got a significant pay raise to save that amount. It's all from making these little tweaks. So at this point, I'm going to see if there's any questions. And we do have one. One is coming out of the FSA conversation. The FSA there's two related to that. One is, can you spend it on prescriptions? Yes, you can. You can go ahead and you can buy your prescriptions. You can actually go ahead and buy over-the-counter drugs, or you can restock your medicine cabinet and then get reimbursed for buying all of those things. Again, with the FSA, someone's asking, what about this use it or lose it? You do have to use the FSA and the DCSA by the end of the calendar year. So if you put in $2,500 into the FSA and you don't use it, so let's say you've got $750 left, you will lose some of that. It used to be all of it, but now you're able to roll some of that over into the next year. But don't fund those accounts so that you have a large portion left. Fund it so you use all the money. All right, so what's next? One, you can become a client and receive personal advice for your situation. A lot of people, they hear these things on the webinars, or they read things in my blog and they want to follow that advice, but they're not sure how to in their situation, or they just want some help. So that's what I do. I work in a number of ways. I either work with people by the hour, or I actually work with people throughout the year and they retain me for my services that way. You can go to financeforteachers.com to learn more about that, or shoot me an email and I'd be happy to tell you more. If you don't want to work with anybody, you can actually view our video training classes that we have online, and you can learn about the changes you can make. And if you're comfortable doing them themselves, you can then go ahead and make those changes. If you do have any questions about that, my email is dave@financeforteachers.com, and you can go ahead and shoot me an email at any point, whether it's a quick question you have on your situation, or if you want to learn more about working with me in more detail. But before you go, I have something I want to give you. It is a book called Dollars and Cents for Teachers. It is more information about how to save money as a teacher, and not by earning more money, but by doing different tweaks with your situation. So this is a free book. I've written it short and punchy. It's not a dry book at all, which things can be when you talk about money. But you can go ahead and go to financeforteachers.com/ebook, and then shoot me your email and I will shoot you the book. And it will download in PDF, and you can just read it on your computer, or you can print it off and read it in paper format. Now that's the end of our session today. Thank you very much for coming along. I hope that some of this information has been useful and you've got some extra things that you can take to school and adjust and save some money. Again, if you have any questions, shoot me an email. Happy to help, and look forward to seeing you on our next webinar. Thanks so much.